Today, UK regulators published their ideas for regulating British pound-backed stablecoins. The SEC pushes forward in its civil suit of Terraform Labs co-founder Do Kwon, and crypto experts weigh in on institutional backing of stablecoins, blockchain tech, and digital assets as a whole. Welcome to CNBC's Crypto World. I'm Jordan Smith. Major cryptocurrencies are starting off the week pretty much flat. Bitcoin had been trading above $35,000 this morning, but by noon Eastern, fell back below to the $34,000 level. Ether traded up about 0.5%, while XRP was among the biggest winners today, climbing 9% since yesterday. Okay, let's talk about the top stories. We've been focused on the trial of Sam Bankman-Fried over the past few weeks, but US regulators are also moving ahead with other crypto-focused court battles. Last week, the SEC asked a federal judge for a summary judgment in its civil case against Terraform Labs and the firm's co-founder Do Kwon. That lawsuit alleges that the company and Do Kwon raised billions of dollars by selling unregistered securities and defrauding investors. And in this latest filing, the agency says that the evidence of violations surrounding the collapse of Terra Luna is clear, undisputed, and overwhelming. Now, for their part, Terraform Labs and Do Kwon have argued in previous filings that they did not issue unregistered securities and that the case should be dismissed. Do Kwon also faces separate criminal fraud charges for which prosecutors are trying to extradite him from Montenegro. Next, the Bank of England and the Financial Conduct Authority are teaming up to craft stablecoin regulation for the UK. Both financial watchdogs just released proposals which lay out guidelines for the industry. The BOE proposes that there should be clearly identifiable payment system operators who assess risks across transactions. It also wants issuers to fully back stablecoins with deposits at the Bank of England. On top of that, there are proposed requirements for issuers to process payments in real time or by end of day. Meanwhile, the FCA wants to require issuers to be authorized to circulate stablecoins backed by the British pound, and like the BOE, pushes for ease of redemption. Now, both UK regulators are seeking comment on these proposals up until February of 2024. All right, sticking with stablecoins for our main story. Last week, Crypto World's Tanay Makil sat down with 3 experts in crypto: Raj Dhamodharan of Mastercard, Stuti Pandey of Kraken Ventures, and David Wells of Enclave Markets, to discuss the state of institutional interest in stablecoins, blockchain technology, and more.
All right, thank you all so much for joining me today. Stuti, welcome back. I do want to talk about the recent movement in stablecoins to start. We obviously saw this big rally in Bitcoin last week, touching 35K, kind of sitting comfortably just below that right now. And as we saw that, we actually saw an increasing number of transactions and on-chain transfer volume in stablecoins just in the last few days, despite the fact that the market cap of stablecoins has been shrinking this year. And the whole market has just kind of been stuck since about May. So I want to turn to David for your history and expertise in stablecoins, but why might that be? And we're going to dig in a little bit more into the various use cases and innovations in this sector of crypto, but why now are we seeing this spike in stablecoin activity?
Yeah, I think that's probably related to a market structure dynamic that happens in crypto markets. So when markets are more volatile, you'll see people positioning capital essentially as buying power to be able to buy or sell or trade, particularly across venues. So you have a lot of trading firms that will trade on multiple different venues, and they'll look for sort of arbitrage opportunities. And so that means you need to have stable coins as sort of buying power to be able to do that.
So, and despite the landscape that I just laid out, it's been, a shrinking, stablecoin market cap has been shrinking all year. Nevertheless, it was kind of a hot topic throughout much of 2023. And Stuti, bring us back to that for a second, because you talked about that a little bit the last time we did this together. Bring us back there for a second. Why are stablecoins such a hot topic, even in what has been a muted crypto market?
Sure. So what the bear market has provided is a bit of a peaceful backdrop for building products that provide sustainable value and reasonable innovation to the crypto space. We're no longer sort of taken up by the energy of the bull market and only these number go up protocols. So one of the things that has been emblematic of this year is rising treasury bill rates, right? And treasury bills offer 2 very compelling utilities to crypto. One is stability, and then the second is yield. So there is both a new crop of stablecoins as well as an existing crop of stablecoins that are looking to take advantage of these properties. On the stability side, if you are collateralizing your stablecoin with treasury bills, you're essentially offering another way to maintain peg stability to the US dollar. And on the yield side, now that rates have been in the range of 5%, you now actually even have an interesting revenue source for your protocol if you are using stablecoins to collateralize, or sorry, if you're using treasury bills to collateralize your stablecoin. You have incumbents such as USDT that are choosing to absorb this revenue for themselves. And then you have an emerging class of startups such as Mountain Protocol or Ondo or even DAI and Frax that are finding ways to share this yield with their users, mostly non-US users, and find a way to differentiate in this market, thanks to this, you could say, like rally in treasury bill rates.
So what happens, and I want to stick with you for this because the rising rate environment has been such a big story we're covering at CNBC, of course. What happens when those yields start to drop in terms of all of the stablecoin innovations that you just named off?
All right, so when yields start to drop, crypto is probably back. So lower yield environments are when investors tend to go into risk assets, which crypto counts as. So overall, like net, it's probably going to be like a great thing for crypto when that starts to happen. So you'll have your incumbent stablecoins, let's say like Frax and DAI and USDC, USDT, which will probably keep allocating to T-bills regardless of the drop in revenue, specifically from that source. Because overall, their market share is probably rising since they're often the base pairs for other trades being made in crypto. Then you have the surgence of startups that are specifically built on this current rates environment. So these are the emerging protocols, stablecoin protocols I mentioned. And then you have what I call real world asset tokenizers that are looking to bring a number of different types of assets on chain, maybe even private credit or real estate, but they're starting with treasury bills because of the current rate environment. I think this latter class definitely will have to do some thinking if yields start to drop. Maybe they'll think about replacing the underlying collateral with other yielding products. But I really think their opportunity is right now, their window of opportunity to take advantage of high rates and start to build up network effects to challenge these incumbents, which honestly have Lindy on their side.
Raj, turning to you, so to what extent does this rate environment affect not just what you at MasterCard, but also your peers in Visa and PayPal? I mean, you guys are working on completely different things from what Stuti was just talking about. So is the high rate environment something that you think about as well?
Yeah, not so much, but I think it is important to think about these stable coins in the context of what use cases that are getting utilized, right? So both David and Stuti talked about different use cases, trading related use cases where stable coins are highly appropriate to use for trade and settlement. But there's also a number of other use cases that's starting to get utilized. For example, remittance is a great place where it could potentially serve. But stablecoins fall into this category of wherever you have a transaction that is limited in scope, can get settled quickly, it gets utilized really, really well. But there are other use cases where you need either a real world asset settlement or a real estate settlement or lending involved, where banks play a much bigger role. And there, another form of currency may be quite interesting as well. So we're starting to look at tokenized forms of deposits, which is really wrapping what's available in bank money, which turns out, I think stablecoin, depending on which ones you count, which ones you don't, there's about 100 billion or so in stablecoins. But the bank money is, I think, as of last time I checked, $17 trillion in US alone, right? They can lend, they can actually be part of much more number of use cases related to real estate, related to lending and so forth. But it doesn't get the benefit of programmable money today, and which we think once you make it possible to do so, it'll open up a lot more use cases. So not to say one category of currency is good for and another one is bad. I think it is really picking the right form of digital currency format for the kind of the use cases that we work on. I think we're just getting started on this new category. It is related to stable coins because it is deposits, and it is also decentralized because there are thousands of financial institutions that actually take deposits and lend. And
we spoke just a couple months ago, I think, because you guys had launched the multi-token network. I believe it was over the summer. Remind our viewers exactly what that is and what your goals are, but I'd also like to hear a little bit about what you've learned from that in the last couple of months.
Yeah, no, it's a great, that example, multi-token network is really a network for making tokenized bank deposits available as programmable money and for different people to build use cases. And we opened up a network test version of the network in UK first, and we saw a lot of real-world asset tokenizers such as real estate providers, carbon credits, even people who are shipping from one location to another where they are actually tracking the shipment and delivering payments on delivery. So a range of use cases, all are traditional use cases that would be served by the banking community, looking to innovate and bring new business models because the money is programmable now. I'll give you one real example. Trade finance was one of the categories where people tokenized invoices, and often people raise money against our account receivable. There are complex flows involved in collecting the money and then distributing the money when it's due. All of that is possible, much more possible, when you have the fundamental building block, the money, as well as the associated asset, both in the programmable form. We also saw use cases where real estate, where you can do escrow payments, which is basically payment on delivery, and that requires coordination as well. You don't want to lock up the liquidity until everyone is ready. That moves money out of the system, and you really not have available for other purposes. But at the same time, you want assurance that the transaction can complete in the end. So all of this opens up new forms of business models that companies are launching on this network, which is what we are seeing.
Okay, so how far away, so we've talked about a lot of different use cases here. How far away are we from this being in the mainstream? And specifically, we've seen a number of headlines crop up in recent days about this idea that tokenization is dead. Let's stick with the tokenization of real-world assets, because that, it's not a new topic, but it is something that has reemerged as a hot topic, I believe, because we've been kind of stuck in terms of liquidity and volume as far as crypto trading goes. So, we've got companies like Mastercard doing all of these new things. But, after this rally, do you see the rally in crypto trading going higher? Do you see a pullback in the popularity of tokenization of real-world assets as a result? David? Yeah,
I think that there's a short-term cycle and a longer-term cycle. I think real-world assets, it's had many different labels and titles. Back in 2017, it was security token offerings. That was kind of the first concept of it, and people were talking about tokenizing art and real estate. And so we've seen these sort of like mini cycles of interest, boom and bust. But I think, and it's a long process, right? The evolution of real-world assets and tokenization in general starts with stablecoins. I think that's the fundamental building block. Now we have a framework for connecting traditional assets to a layer one or to a public blockchain. Next is going to be foreign exchange, where we have right now 99% of stablecoins are USD based, sort of the reserve currency of crypto trading. So we'll see FX markets start to move in that fashion under the same framework. At the same time, we have started to see regulators, like very well-respected regulators in developed economies, start to actually work together on a real regulatory framework to allow this, and start to have pilot programs and sandboxes working with some of the largest financial institutions in the world and asset managers. And so through that framework, it's going to take time to build that out, of course, because we're connecting a system that's been around for 100 plus years with a technology that's been around for 10 to 15 years. So it will take time, but I think eventually underneath these frameworks and with the interoperability from a technology perspective that's offered by using a common communication language, a common protocol, and also common regulatory standards across different types of markets, now you'll be able to have assets that are tokenized and are fungible across different jurisdictions and geographies, and that's where the real value. So I think at some point we'll see an inflection point of these things like starting to take off. And I know you're probably smiling because people have been saying this for a long time.
Well, at what point? At what point do we see it?
I think there are two things that need to come together for this to really take off, right? There is a money side and there is an asset side. You need scalable money on one side. There are different forms of money, like we talked about, for different purposes. We need that. And we need different types of assets available as well. And who is the provider of the tokenized asset? And who provides the trust that it's indeed, that tokenized form of the asset is indeed what the asset it represents behind the scenes. It's the real estate, or it is the carbon credit, or it is the invoice that we're talking about. We need those mainstream providers. They're not crypto companies. They are B2B companies that are there today that offer these assets using a non-crypto, non-blockchain technology. They need to come on board as well. And that's what we started seeing when we ran this innovation sprint in UK. We started seeing financial institutions coming in, providing scalable money, and asset providers coming in, providing that last mile of trust that you need, so that when you have the tokenized asset on chain, you know that truly it represents the asset, right? So I think that is, there are a few other things like identity and trust and compliance and making sure that the environment is safe and sound. But the core building blocks are scalable money and scalable asset provider list.
And going back to your note about regulation, are you guys feeling optimistic about the regulatory path here in the U.S.? Start with you, Raj.
Look, on the stablecoin side, I think there has been as much clarity as you have seen. The state side is providing. The New York State is leading the regulatory framework on that. There is a number of bills that are proposed right now on the overall federal level. We'll see what happens. You've seen even today, UK proposed a stablecoin regulation this morning. MiCA in Europe has already a law of the land. I think we welcome this increased regulatory clarity. I think what it'll provide is it'll clarify what assets that need to back and how you can consider a stable coin to be compliant. But beyond that, I think the financial institutions also starting to enter in the space. You may have seen a number of announcements, and they're using existing money that is already regulated that they're trying to apply this technology to. So you'd see overall it is moving in the right direction. Obviously, there are multiple jurisdictions, varied laws. It'll take time, right?
And going back to the idea of market structure, a lot of times most of the time when I think about stablecoins, I think about them being this sort of bridge currency for crypto traders to move in and out of assets without having to leave crypto. And we have seen this trend of U.S. exchanges moving away from regular U.S. direct withdrawals. Do you see stablecoins playing a bigger role in this ecosystem? As there's a reckoning between banking and crypto, Stuti?
Sure. So traditionally stablecoins are seen as base pairs for trading, et cetera, right? But one very interesting use case that is on the rise is stablecoins being used in emerging economies. And in this use case, you can see stablecoins as not just as digital dollars, but as dollar diplomacy. So in the US, we can take the stability of the US dollar kind of for granted. But let's say you go to Turkey or Latin America, that is just no longer the case. And in jurisdictions like those, stablecoins are giving average citizens access to a better alternative, right? That is often pegged to the US dollar. So, I saw one interesting statistic that in Turkey, Tether, which is a leading stablecoin, has 20% of volume on BTC Turk, which is one of the leading digital asset currency exchanges in Turkey. And that is opposed to 1% of the volume on Binance. So this is a signal of strong Turkish demand for stablecoins, given that lira, their inherent currency, is unstable these days. So what I'm seeing is that stablecoins are actually creating rails to easily export US dollars and, in my eyes, also export human welfare to these geographies.
Also, Raj mentioned payments, international payments and remittances. I think the entrance of more traditional fintech companies like a PayPal launching their PayPal USD, it shows the long-term view of this being a much larger use case than just sort of in the crypto trading markets. I think you'll see more entrants into the space like that are neobanks or fintech forward companies. And they see the real opportunity beyond just sort of like trading.
All right, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.